which is written by, I believe he's still a Princeton professor, and the book was actually called A Random Walk Down Wall Street. There's
Hey guys, give us a minute, let people stroll in. Oh. See if I can get the camera to work. Here we go. Okay. You'll notice that things are a little different this week. Bear with me. Had a little trouble getting logged in for whatever reason. And gotta send a message here. Give me a second here. So we set this up as a meeting rather than a webinar to allow you guys to do something with chat. So I asked Karen if we could do that. So we'll see how this works out, and this way you guys can put stuff in chat without having to put it in the question, see if this is easier for everyone. So, and I had trouble getting into the room because of the changing configuration. So finding my bearings here, so bear with me. It's Thursday, October 23rd, 2025, and hey, we're having another rally. How you like that? So after extreme weakness yesterday, we're seeing the market like the proverbial honey badger don't care, and it's coming back real nicely. So hopefully you're participating, you're making money, and you know, I can't count the number of people who said that we would not be at all-time highs for a long, long time after the October 10th, and all I see is volatility being sold. So I take it you guys can hear me okay? Give me a thumbs up if you can. I think you can see the chat. Again, anyone can hear me? Okay, I'm getting a thumbs up. So I take it that means you can hear me. Again, I apologize for the a little bit of confusion here as I figure this out. I guess in the meeting mode, the little icons don't come up. So let's get started, and forgive me. I'm going to do our usual kind of look at the markets, and yeah, nobody should have their camera on. And let's see if I can fix that. So and I'm not seeing, all right, where's,
Hey, Sam, it's Joe. I'm not seeing anything to get into a chat.
yeah, I'm not seeing it either, Joe. So um, we'll have a little bit of kind of growing pains here as we figure out. I should have done this with Karen to see how, I'm not seeing it either, and whether I'm looking for um, a setting to turn on the chat. But Karen had listened to one of our previous webinars and asked and heard me say that it would be nice to have a chat. And so she set it up for me like that. I guess Dan doesn't like to have the uh, the chat turned on, but so if anybody has a clue here, all right, let me mute everybody and we can just get started. So if you have a webcam on, go ahead and turn it off. I'm just going to get started here. Okay, and I am still overseas, so still trying to get things working, spending time here, and because of my mother-in-law, she's back home doing better, but she is going to have surgery, so we're going to be here for a while, and they're just getting her ready for that in the next month or so, so I'll be here for a while. But she is getting better, she's looking better, and we will be here, mostly my wife, to take care of her. So let's see if I can start sharing these. And no, I didn't want that. Okay. Make sure that you guys can see this. Okay. Should be able to see a tri-pane chart here. It's telling me that you're not seeing this. See what I shared. Okay, so this is shared. Okay. All right. So we're let me let the now I kind of see a little bit why Dan doesn't like this. I wonder if there's a way for me to admit let everybody in without having to confirm them coming in. So sorry about the delays, guys. All right, so SPX. We had a bit of volatility. We're looking at the daily, weekly, and monthly. And you can see today's candle is on the daily is overtaking yesterday's high after that little dip down in the afternoon. So it basically negated yesterday's bearish candle and any effects that might have had. So we're not too far, 67.45, 19 points from an all-time high. And who'd have thunk it after this big wide range bar? And we're about to take that out. And I have little doubt that we will. On the weekly, you can see here that we're above last week's high and about to take out that ugly red candle. MACD has not flipped negative on the weekly chart. And by the way, looking at the daily chart, the MACD looks like it wants to flip back to positive. How about that? Never went negative on the monthly chart. And we are, as you can see, in the middle of the range between the lower edge of the implied move for the week and the upper edge of the implied move. We had an expected move of about 135 points for the week, plus or minus, which is about 65 points less than we had the week before. And that is attributable to the decline in implied volatility. And you can see that we are right in the middle of this range. And in a second, we'll take a look at where we have in terms of a remaining move for tomorrow in the SPX, given that we're supposed to get a CPI, Consumer Price Index economic report. So I would not have expected this kind of strength ahead of the CPI. I would have thought that they would have waited to get that report, but apparently Honey Badger don't care. But looking good. And once again, proves that getting bearish in this kind of market is not going to be pay off. And even a bearish day like yesterday couldn't discourage the bears, the bulls. And you can see here on the NASDAQ, we're going to get another flip of the fast line over the signal line on the MACD. The NDX on the weekly never turned negative, and 25,195, we're less than, I guess we're about 90 points away from the all-time high in the NASDAQ. And I think it was yesterday or the day before that the Dow made a new all-time high. Here's the monthly, and look at that beautiful chart. Nothing wrong with that. Red hot, overbought, 76 on the relative strength index. Back at a 68 on the weekly, and we have a MACD trying to turn up. So NASDAQ, SPX look very similar, and we are trying to move forward. So let me see here. I'm going to turn off my camera. That way it's not in the way. You don't need to see my mug the whole time. Unless everybody votes on it and says they want me on camera. But since you can't see the chat, I guess you can't put that in. But we'll figure this out and get it right. So let's take a look at the rut. Finally, also trying to take out yesterday's high. So this one's looking better. It's up 1.3% on the day. So that's kind of nice to see the Russell 2000 small caps participating. MACD is definitely not trying to flip back over, and we're kind of middling as far as the relative strength index, RSI. We're in the 50s. Still pretty strong on the weekly RSI, and you can see here it's not quite a hammer, but a pretty good uh, candle here on the weekly, and then the MACD is positive, and then also the RUT on the monthly still looking really good. So the whole point of going through this with you guys is, and you don't have to be a top-down trader like I am, but when you zoom out to the monthly and the weekly and the daily, and while you may be just an intraday trader or just a few day trader here and there, you know, if you look at these every night or every morning before the trading day, it gives you perspective on things in the market, and it helps you stay positioned correctly. And obviously, whatever happens on the daily will propagate to the weekly and then eventually to the monthly. And so whether you start with the monthly and move down to shorter time frames, or you start with the dailies and move to monthly time frames, keeping the monthly in perspective and seeing that, look, we are one time framing on the monthlies, which means that no low of any month violated the low of the prior month. Well, this one kind of did, had a little tail, but ended up closing above the low of that one. We did have a violation of one time framing on the daily, obviously coming down after this October 10th bar, but here we are on the mend. Next thing we take a look at is the VIX, and I really only care about the daily. And we can see here that we got as high as 28.99 in the pre-market, and that's back on the 17th. And all we've been doing is coming right down. So we're all the way down to 17 on the VIX. So we're below all the moving averages except the 50 down here. And we just lost the 200-day. And that's usually a bullish signal for the market when the VIX is under the 200-day. And we might even see, if this bullishness continues, the VIX to go down below the 50-day. So nothing bearish in the market about this particular VIX level. And you can see we had a pretty good spike here. Yeah, I guess it was yesterday. That was, I think it might have hit that in the pre-market. And here we are here down to the 17. No, that was the week of the 17th. I'm sorry. Yesterday, what did we hit? We only got to 21 yesterday. So let's take a look at and make sure that we can see what's happening with the VIX. So we're down 7.5% after being essentially down yesterday. So what we want to take a look at is the VIX option pricing. And for those of you that are new, I always take a look at what the VIX options are pricing out to know where the bias is by a lot of the institutional traders. And so we're at 17.22 right now. Let's call it 17. And if you're bearish on the market, you're going to go and buy a call on the VIX. And that would be the 18 calls. And that would be costing you about $2.14. And then if you go out and look at the 16 calls, those will only cost you 24 cents. Now, this is a little bit concerning because this is the next monthly VIX expiration, and these are pricing out almost at 10 times the calls versus the puts. And while this is only one data point, this is a data point in the feather of the cap of the bears, because when I see this much, it means that we're not done with volatility, not by a long shot. And what I didn't show you guys, let me maximize this to make it one. the volatility of the VIX is down under the 100 mark. So we got as high on the 17th as 137 on the VVIX. And once we get over 100, and particularly over 110 in the volatility, this tells you that the institutions are really hedging. And what they hedge with is VIX options, SPY, and SPX puts and what have you. But now we're under the 100 one, the critical 100 level. So this is a feather in the cap of the bull side of things. So the other thing I want to show you is that in the VIX futures, now the pricing of the VIX calls and puts is much dependent upon what the VIX futures are / VX. And so our current active VIX future month is expiring in 27 days. And that's just basically 1 day greater than the monthly VIX options expiration. So VIX futures expire on a Wednesday morning, and the last day to trade the monthly VIX options is Tuesday night beforehand. And so that's in 26 days for the VIX options, 27 days for the VIX futures. And therefore, we're seeing in the VIX futures a level of 19 versus the spot VIX, which we just saw as 1901. Now, I want to take another look here and see if, as one would expect, that the VIX be higher as you go out in time. And if we go out 55 days to the December expiration, that's 19.67, 20.82, 21.31. This is a normal configuration for the VIX futures. And again, the fact that the spot VIX is lower than all of the future VIX, the VIX futures all the way out to 208 days. And what you're seeing is a configuration where the further you go on time, the higher the VIX. That tells me that that's a feather in the bull's camp. And this is a configuration that you might have heard referred to as contango, which means the farther you go out, the higher the level. If you get into backwardation, like we had last week when people were a bit nervous and buying VIX calls and SPY puts and SPX puts, we saw that the spot VIX was higher than the upcoming VIX expiration. So mixed messages from the VIX, but my conclusion is we're not done with volatility, even though the bulls have the ball. And I guess for the next couple of weeks, the real bullishness doesn't start until November, say second week in November. But with a lot of portfolio managers behind their benchmarks, they may not be waiting for it. You can tell that they're buying any weakness at all to get into this market before the calendar turns and they miss out on their bonuses. Like I said, we have the CPI tomorrow report before the market open. And of the 135 points that we had for the entire week, the expected move for the entire week, we have about 48 left for tomorrow. So it's better than a third for the week, given that 135 was a full week move. So we have like a couple days worth into 1 day. So plus or minus 48 points, be a buyer, not a seller of short-term options into tomorrow if you're going to do anything with options. So 47 points. Now, let me see if I can figure out where the questions are and show the meeting. I don't see the module for questions, and you guys probably don't see it either. So give me a second. to see if there's something I need to click on. To allow questions, but that might be set on Dan's end for the account. So I apologize, guys. You know, if we can't get any questions, and you want to put one in, I'm still looking here, host tools. Yeah, I don't see. Yeah, I apologize, guys. I don't see it here. I have a corporate account of my own, and I'm able to see and set the question panel or the chat panel. So yeah. So what I would say is if you want to send me a question, send it to sam@optionmarketmentor.com, and I'll try to do them this way, and we'll have this figured out for next week. So no good deed goes unpunished, and we try to make it better for you guys. We've made it a little bit worse. So yeah, I don't see anything. I bet you that it's on the GoToMeeting or the Zoom control panel that I don't have access to, and either Karen or Dan will have to turn that on. So my apologies. Okay, so let's take a look at our trades, and I'll try to monitor email for any questions that come in. So sam@optionmarketmentor.com. Don't hate me because it's a long email because I didn't pick it. Okay. So let's take a look at our trades. Resize this. Come on. All right. So let's start with our first one. AAOI is our first trade here. And yeah, just like everything else in the market, we had a couple day dip here, and we're bouncing nicely here, up 5%. I wouldn't blame you if you stopped out on this yesterday, because we came back essentially past our first target, but we never really tripped the stop. And so I decided to keep it on. But in any case, we've taken one target at 4.3. And I think this one, because it's a longer term trade, and this is how you can kind of read my mind a little bit. If it's something that's out 60 to 90 days, then we want to be a little bit more graceful and give it more time to work for us. So sorry about that. Didn't have just my trades on here, and it's not sorted properly. Okay. So AAOI still alive. I still like it, and we never really hit the stop. So AAOI looking good. Costco doing what it's been doing for a long time now, just down and up and down and up and down and up. And so we have a November 880, 850 bull put spread. We're up 26% on this, and it's pricing out at about $2.62. So once we get down to $1.50, you'll want to take about half, a third to a half of your position off if you have multiple units, and then we'll try to ride this through. I don't think they have earnings for a long time. The last earnings was basically on September 25th. So I guess I wouldn't expect earnings till about I'll say Christmas or so. So Costco, we keep selling these put spreads and they keep working out. Ethereum, not showing the strength I would have expected, not especially since Bitcoin seems to be recovering nicely and took back that 110,000 level on Bitcoin. But we did stop out of the call spread that we had in Ethereum because we did come back to our original cost basis on it. So I had to stop out of that. But we still have the short puts, the 30 puts, and we're right on the dance floor with it. We're right at 29.66. So essentially, this one is a bit underwater, but this was something that we rolled from October after a successful trade. And so we'll hang on to this. We sold it for $1.24. So we're down about 115%. It's at $2.67. But I usually hold these things through about 4 or 5 times the premium before I start getting concerned about this. I wouldn't expect that anything on the consumer staple side is going to do very well when a risk-on rally is. And Flower Foods is basically a risk-off name, as are most consumer staples. And so it looked like it was going to bust a move yesterday, and now it's being pulled back. We're down 11%. We paid essentially 85 cents for these, less than $1, and we have a stop at 40 cents here, giving this a try. It was looking like the MACD and the RSI were having positive divergences. We'll see if this works out for us. Goldman Sachs, we did a short put, and maybe you did the put spread, and of course promptly tanked yesterday, and then coming back a little bit today, up $9, up 1.29%. Not bad, but financials have some degree of relative weakness overall, but so far so good. This expires at the end of the month, so we have a week, 8 days to go on this. And if you sold multiple units, if you can buy some back for like $1.10, $1.15, buy back a third to half of them, so you're not carrying so much risk. And that's what you want to do, is put the probabilities in your favor by trimming some of these as things go along. Hormel, here's another one where it looked like it was going to get going along with the staples, and this blue line is my 21. I'm not sure why it's blue. It's usually green, but that's what happens when I change the system colors. All right, so couldn't really hurdle the 21 EMA, and I expect this to get up to at least the 50-day to allow us to maybe harvest some of these for a 50% profit, but it's not to be just yet. But this is a long-term trade into January. If you're not in these, you can definitely get into it now. What we did here, if you're a new member, and you can get in at a better price than we did. This is a long-term hold, and if you don't believe in buying long-term leaps, which are the long-term options, go ahead and buy the stock. I mean, I know this is Option Market Mentor, not Stock Market Mentor, but if you want to collect the dividend, I believe that this is going to turn out to be a great trade. It's just going to need a little bit of help from the consumer staples sectors, which I think at some point we're going to see, and that's why I gave us a lot of time. But we are down about 100%, and I added some earlier this week to mine, and so it's one of my bigger positions. All right, IBIT. IBIT is the Bitcoin, and we bought a call on this, and we added to it. So I have to talk to the developers because our cost basis is not 523 because we had two tranches. Our cost basis is really, I think about $3.18, or I think actually, yeah, $3.18. And so we set a stop at about $1.30 for these. And right now, what you do with these, because it's not really averaging the prices, it's adding them together. So it's at $2.60 and $5.23. I guess that's yeah, I guess we're close to break even according to this calculation is working properly. So we need to fix this with the system. But essentially, because we bought two tranches of this at different times at different prices, it's adding them up. So we're basically break even on these. These are November 65 calls. And if Bitcoin is going to rally as it seasonally does this time of year, these should benefit. So I actually added a couple on the volatility this week, but I didn't make it official because I don't want to keep adding and influencing members based on my instincts necessarily. But obviously, you've got to trade your own account and you can figure out what is best for you to do. So let's see here. IWM finally coming to life and getting a little rally. So after making an all-time high at 252, we came all the way down yesterday to 240. So a $12 pullback. And now we're getting about a $3.50 rally. So we are above 246.86 and 246.82. So did we take out the high? Yeah, we did take out the high today. So yesterday's high. So we're good. We still have a lot of time on these out to December. This is a combo. So what we did was we bought a 250, 270 call spread and sold a 230, 220, 210 put spread. And you can still do this if you're not in it or if you want to add to it. I'm okay with that. I think that if we're going to have a rally into year end, IWM is going to participate. And hopefully, though hope has no part of this equation, catch up and basically outrun the NASDAQ and the SPY, though with the AI trade influencing tech, I don't think it's going to be able to quite play catch up. But whatever it does, as long as it's going from the lower left to the upper right, we'll take it. J&J, we have a long-term covered call in this one. Hasn't been doing anything really. And this is kind of the slow trade. And for those of you in it, it's basically there's nothing really to do. It hasn't really rallied, hasn't gone down. It's a deep in the money call. And it's just a kind of a safe way to get into a blue chip name. And they have reported earnings. So if somebody were initiating a trade here and we have ex-dividend coming up on 11/25, so you may want to wait. But I usually like to do these close to the ex-dividend date. But if you wanted to do a covered call, I mean, you could do it right here. Let me maximize this screen. You could do a covered call right at 190, or you can go a little bit in the money. Where's the good open interest? Yeah, right there. 185. I don't like how wide is it. It's a $1.10 wide. This is a little bit better. Depends on how deep you want to go and how much appreciation you want in it. Obviously, this is a slow trade, and you'd be buying it to kind of benefit from the decay. And the further you go into the money, as we did through one of our lessons, the more protection you have. But you can see here that your max gain on this, if you are assigned, is going to be $1.23. But if you do the near or just slightly in the money, you have a maximum possible gain of $2.75, because that's the extrinsic value of the in the money call. So like I said, with the next dividend date coming up, we've already collected $1.30 dividend. You can collect another one. I know, exciting, right, guys? Okay. All right, Microsoft. This one was green on a red day. So let me go back here. And I've set our next target on this one aggressively to 19, because we have until January on these. We've taken 3 profit targets, so I wanted to kind of slow our roll. And I may very well take something. If they give us 16 or 17, I may take that depending on what the action is in Microsoft. But really held up well yesterday until late in the day. And here we are back up a couple of bucks. So we have this combo. And if I were doing this today, I would definitely reposition and look for something like say a 520, 550 call spread, and sell perhaps. Well, let me just do that for anyone who wants to do it. And I would wait for just a little weakness. I don't like to buy stuff when it's up. But if you're new and you want to set up a trade, you could do the 529, 525, 550s, and then you could sell out, say, 480, 460. And, don't feel like you have to stick with my strikes. I'm going out 1 standard deviation. Basically, we expect a $52 move, and so 470 would be really 1 standard deviation. So I like to sell a put at a 20 delta approximately when I'm doing this kind of thing. So you could do something similar to this, but feel free to play with the strikes if you need to, if you don't have a position in Microsoft. But again, I'd rather do it when it's down a few bucks than when it's up a few bucks, but you got to do you. All right. NVIDIA, we have a perennial, we've been doing this for months now, selling puts or put spreads. This is a 170, 160 put spread in November. And given the pullback from the 195 all-time high, and we got all the way down to 176 on here, and now we're rallying back with the market. So we have, we're down 12.5%. But I mean, this is the gift that keeps on giving, and it's kind of one of our perennial put sales or put spread sales. And one of the things I looked at today, because the volatility in NVIDIA is really up there. So is maybe a covered call right in the money. Now, NVIDIA, if you own the shares, they couldn't be more generous than with a penny dividend every quarter, right? I mean, this is basically, I don't think I've seen a cheaper dividend, but it is a tech stock. So someone who has 100,000 shares probably gets $1,000 every quarter, is happy. But obviously, this is not a dividend payer. But again, I'd wait for a little bit of weakness, but you could do something like this. I liked the fact that if I come over here and I look at the IV percentile, 26% is pretty good for NVIDIA, and anything over 20% is good. So you're getting good premiums. So, and you definitely have good liquidity. So you could go slightly in the money if you want to do a kind of a covered call. You can see here the extrinsic value of selling the 180 call is gives you about $4.89 of protection of extrinsic value. So you have like $5 of upside. It's a delta of 59, so it's reducing your risk by at least initially by about 59%. So when you sell this call, let's just do this. So buy covered stock, and let's analyze this trade. So if you do this covered call, you're basically long 40 deltas of NVIDIA, and you've got 15 days basically to either pocket this extrinsic value or to make something or have it pull back and keep all of it and keep your shares. Who knows? But yeah, the 180s I like. Lots of open interest, 9,000. I think that's ideal. If you wanted to do a short-term covered call on NVIDIA and take advantage of the higher volatility. And we already have a put spread. So that's just one idea for you. And like I said, I almost put that in the room, but I thought, I'll just present it here, and anyone who wants to do it can do it. So let me resize this, keep this going. All right, Oracle. This is our one sad sack, so to speak, and finally bouncing here. And we never really got stopped out. On a closing basis, I've got our stop set to what, 270. We tapped right below there, but I had set it right around the 50-day. Not sure where the weakness keeps coming from, but obviously this was a gamma squeeze, plain and simple. And we're finally dissipating that. We did not quite close the gap, the earnings gap, but we certainly, pulled back $75 from the high. And with the stock up 3.5% or $9, hopefully this was a short-term bottom. But if we take out this ATR trailing stop on a closing basis, then I'll have to rethink this one. I put it all the way out to January because I expect some volatility. I expected some consolidation. But honestly, I wasn't expecting a $75 pullback. Otherwise, I would not have put this one on. But I'm still in it. I've added a little bit on along the way, but I stopped adding when it would do this and come back down, and it did this again, and here we come back down. But you can kind of draw a box around this range, and I think eventually it's going to get into gear and get going. I like Oracle. I wish I could get it for 240, 250, but obviously that would stop out this trade. But I get that you probably are concerned about this trade, and what I say to all members with respect to any trade they're concerned about, you've got to set your own risk parameters. And just because I suggest a stop or a target doesn't mean you have to follow along with Sam. You can play your own and do your own account the way it best suits your risk reward parameters. PLTR, again, along with everything else, showed some weakness. MACD is above the zero line, but it's still not positive. We don't have the fast line over the signal line. But I mean, we've been going sideways, and that's what we have. We have a put spread, a bull put spread that does exactly what we want it to do. The stock goes sideways. And this kind of explains a little bit why I haven't bought long premium in Palantir. And if we go all the way back to, what's this, August, so 2.5 months now, we have not made any progress in Palantir. We are up, we're down, we're up, and now we're consolidating. So I have good confidence that Palantir will hit $200 by year end, assuming the market stays bullish through year end. But I don't know what that path and when that path is going to be. That is a pay grade that is above mine. SPY. I was watching this closely yesterday, and what told me that the bearishness was not that intense yesterday, and not to mention that the breadth wasn't that bad yesterday. I think we had like 60% of volume that was down. Is that this particular long call spread or put spread just couldn't get over like 550 or something like that. We couldn't get up to a 50% premium. Now we've taken a couple of call spread profits on here, and I have it set to 9, but I would have been happy getting another 7 out of this yesterday, just given how reluctant the market was to go down. I know I skipped over the short put here to go to this, but essentially we have 15 days on this bear put spread, and with the volatility I'm still expecting through month end, through the first week of November, we'll keep this on, but it might be on a tight leash. We paid $4.34. We are below our cost basis, but we have taken a couple profit targets. And typically what I would do is if we came back to our cost basis, then I would stop out of this. But this is our only hedge, and I want to keep this on, and you have to decide for yourself if that's what you want to do. But like I said, we have taken a couple of profit targets. And once again, if I see it necessary, or I think that we need to roll this out in time, then I will do so, and probably do that within about 10 days of expiration. We'll see what the market does, but I still think with the volatility we have, it's a good idea to have this. Now, we sold a far dated put in January, the 575 put, to finance this particular call spread or put spread, and that's up 25%. So we sold it for 444. It's at 332. So together these are a got a little tongue tied here. An inflection point spread. He tried to blurt out, and so these together are one and the same, or are part of the same trade, but I made them separate so that we could take profits on them separately, and members seem to understand these a little bit better. So that's what happened, guys, when you get all flustered and you can't get started right and things are not working the way you expect. But we'll get it better. You guys deserve better, and I'm not happy with the quality of today's presentation, but bear with us as we make some changes to make this better for you guys. So TLT, this is also our perennial put sale that we've been doing since last year, if not every month, every other month. And this one's up 30% for us. We're selling puts. And again, if I switch to a weekly chart on TLT, it looks like a mess, but you can go all the way back here to April of 2024, and this is where TLT was trading. And here we are in October, a year and a half later, October of 2025, and we're still about the same level. And this is just the ideal environment for us to sell puts, and that's what we've been doing. And I've stayed away from buying calls. We tried this a couple of times earlier in the year, and maybe late last year. We just weren't getting anywhere with long premium, but the short premium put sales have been working out and will continue to work out as long as rates stay range bound. Finally, our other long-term consumer staples oriented play is XLP. And oh, look at that. We're up 5% on these. And I've added to this one as well. I have a lot of confidence that consumer staples at some point will recover. They're oversold. And it's not going to fare well on a day where you have risk on, because it's a defensive sector. And you can see yesterday when the market was up, this tried to hurdle this blue line, the 50-day. And so we'll just hold on to these since they're a January 2027 play. And yeah, 5%. And this is another trade. If you're new to the room, if you're not in this or you want to add to this, I would bless adding to this particular trade, as long as you understand, it's out to January 27th. So it's about a 15-month trade. We're going to be in this for at least 6, 12, 18 months. This is the idea behind these long-term trades. And if that doesn't interest you, you can either buy the shares of XLP or you can skip this trade altogether. So right now we have about 17 open trades. I like to keep them to 20 or less. Have been looking, haven't really seen a whole lot that I wanted to see a little bit more pop and implied volatility yesterday to do some more put selling. And obviously we did the Goldman Sachs a couple of days ago, but that was before the pop and volatility. I wish I was a day later on that. But in any case, let me check to see if any questions came in. I'm not seeing any, guys. Yeah, sam@optionmarketmentor.com if you want to send me something. And okay. Let me bring up the panel here. And more. Great. I guess that's it. All right. So not seeing any questions, so I'll just move on to kind of our little tutorial. And what I wanted to do today is, I started to put together a PowerPoint presentation for this particular topic, about probability, risk, and price. And this is kind of an approach to trading, and question I get all the time about doing trades, especially the ones where we're selling puts or put spreads, or we're buying very trades where the risk reward seems like it's kind of skewed to the wrong way. And so what I thought I'd talk about is what do we do when we're talking about, let me make sure this is set up correctly, and we'll switch to the SPX. Talk about, typical trading of stock and what we would do in the option market. And so oftentimes members and friends would ask me, so why the heck are we coming in, and I'll switch to SPY here. Why the heck are we coming in to sell a put spread, say out in November? We can take any one of our trades as an example, but say selling a 650, 640 put spread to collect a measly $1.17. And if we do a confirm and send, we have $883 of risk. I mean, isn't that just plain stupid? I mean, you're risking 9 to make 1. And what I'm here to tell you is that it's not always about the ratio of gains to losses. A lot of it is about the probabilities of making money. Now, let's take a typical stock that you might buy, call it a $50 stock. And when I talk to traders and I hear from traders, well, my risk reward is 2 to 1. I want to make $2 for every dollar I risk. So if I buy a $50 stock, I'm going to risk $1. So I'm going to stop out at 49, but once I get to 52, I'm out. So a 2 to 1 risk to reward ratio. And that sounds really good on paper. But when you think about it, whether in the context of options or in the context of stock, that particular kind of method of trading really has not a 50-50 shot of making money if that's what your risk reward is. It's more you have an overall a 33% chance of getting that $2 increase generally, and a 67% chance of losing $1. And so the probabilities matter the way you construct them. And so in this case of selling a put spread, I'm coming out to the 650 strike. And if you equate risk or probabilities with the deltas that we have here, the 23 delta, that is a 23% chance of this option closing in the money. And which means that I have a 77% chance that I will keep this money. And although the risk reward, in this particular trade is skewed to the downside, I could lose $8 for every dollar. I have a 77% chance of making this work. So if I'm risking 8 to make 1, and I have a 77% chance of making that money, if you look at this, not over the course of 1, 2, 5, or 10 trades, and if you subscribe to any of Tom Sosnoff's training or any of the Tasty Trade trainings, it's all about the number of occurrences that you put in place. And so if we're talking about hundreds of trades and you're talking about a 77% probability of success, over time, that 77% is going to work out in your favor, and it's going to more than show profitability over hundreds, if not thousands of occurrences. Now, I make a ton of trades, probably more trades than I'm going to say 70 or 80% of people do. I take a lot of shots in the market, and especially when it comes to selling puts or buying a narrow put spread or buying a narrow call spread, a 1-to-1. I'll talk about that in a minute. So when you think about it, every trade that we do involves some risk. And so when you're taking risk, you want the probabilities in your favor. And it's not always about, okay, I'm going to risk 1 to make 2. Well, what if you risk 2 to make 1? Mathematically, if you're risking 2 to make 1, your odds just went up from a 50-50 shot. Because let's start out, you want to have a 1-to-1 ratio. I'm going to risk 1 to make 1. Okay. So you have a 50-50 chance. And over hundreds of those trades, after commissions and fees, you'll probably end up somewhere less than break even. But let's say you're taking a trade where you have a 2-to-1 chance of making money. So let's say we came and we did, where's at the money right here, we sold a 673, 663 put spread. So I'm going to collect $3 out of that. Okay. And this particular trade has a 52% chance of making money. Now, I'm going to grant you that this is not going to look too good because I'm guessing that the implied volatility, yeah, the skew is not in my favor. So what's happening here is I am selling a put here that has, where's my implied volatility column? I probably should put on my glasses. Okay, so implied volatility of these 673 puts is 14.26%. And the implied volatility of the puts that I'm buying is 15.74%. So the skew is not in my favor. So this might not be the best example, but let's take it on the call side, because when I see that that the implied volatility of the option I'm buying is greater than the implied volatility of the option I'm selling, then skew is not in my favor, the wind is not at my back. Then I switch over and I decide to look at the call side, if that's the way I want to profit from movement in the SPY. Now, the implied volatility, I have way too many columns of the, if I'm buying a 673, 683, okay. And to form this spread, guys, I'm basically clicking on the 673, the ask for the 673, holding down the control key and pressing the 683 on the bid side to form this spread. All right. So this is going to cost me $5.53. So what's my risk reward here? Max profit is 448, max loss 552. Here's a 1-to-1 ratio. But look what's happening here. I'll be darned. The skew has switched on us. So I am, again, the skew was not like this when I was playing with this over the weekends. The skew has slipped. So this is not going to work out for me either, because the option that I'm selling has a that I'm buying has a 14.1% volatility, and this is a 12.74% volatility. So I'm going to switch again. So I didn't like that one. So let's say I want to, the SPY is up $4.55, and I want to sell some premium here. And so what I generally do is I go out to like a 30 delta, and I can sell, let's say, a 5-point call spread. Okay. 687, 692. So 687, that's a 30 delta, which means that I have a 70% chance of keeping this premium. Now, I am selling premium worth 12.2 with a 12.2% implied volatility, and I'm buying a call that's with an 11.6% volatility. And to you, that might be like 0.6%. What's the big deal? Believe me, guys, when you're doing hundreds of trades like this, it matters, because even that 0.6% difference in implied volatility can definitely increase the odds of making money. So let's do a confirm and send and look at this one and say, okay, I am risking $344 to make $156. Now, what idiot would do this? And I'm going to tell you, I'm the idiot that does this all the time. And you know what? Because this is a 30 delta, I have a 70% chance of keeping this entire $1.56. And I'm going to do this all day, every day, especially when the skew is in my favor and the SPY is up $4. Now, you can do one of two things. When you get a 50% profit in these, you can let half of them go, or you can let them all go. And what I do is, if I have a 30% profit in anything that I buy or sell within 3 trading days, I take the whole thing off. I say, thank you very much. I'm taking my money and run. And sure, I may have a 1 lot, 2 lot, 3 lot. And it's not a lot of money, but again, uh, normally I'm looking for 50 to 55% profit on these. And I usually just close them. Or if I get a 30% profit within a day or two, then I'll close them all as well and say, thank you very much. And again, trading is about using the probabilities and taking advantage of them over hundreds of occurrences, and not just 5 or 10 this week and next week. Every trade is different. And now the other part of this whole thing is something that we've talked about a lot in our tutorials, is about when you're creating an inventory of trades. Now you are a trader, yes, but eventually you accumulate 20, 30, 40 trades, especially if you're someone who likes to sell premium and you like to work with a lot of underlyings. I can tell you that, at any one time I have 30, 40, 50 trades on that are kind of brewing, and they're in different time frames and what have you. And I just let them do their things. It's not like they're all directional plays. Some of them are premium plays. Some of them are counter trend trades. So I have a little bit of everything. But the key to managing risk is basically managing your trades. And so you have to stay on top of this. And the thing about doing trades like this and using the probabilities in your favor, even though, in this case, I have a $156 potential reward and almost double that, more than double that as a risk. I'm okay with that because the odds are in my favor. And, mathematically, these odds over the long term, over the course of, again, I'm going to say it again, hundreds or thousands of trades, ends up working out in your favor. And, I've heard people say this all the time. They come and say that, if you put this trade on, they'll come out here and say, we'll do the 695 700s, okay? Collect 83 cents. Typically, by the way, I like to do this when I can collect 1/3 of the width of the spread. So 695 700, that's a $5. I want to collect about $1.66 when I do this. And believe me, when the skew is in your favor like it is here, it's a lot easier to do. So what did we collected $1.56, not quite 1/3 of the width of the strikes. Again, doesn't have to be exactly to the penny or what have you. You don't have to engineer this death. If you're close to 1/3 of the width of the strikes, that's okay. In this case, it's a $5 widespread. I'm only collecting 83 cents. And look at this, I'm going to risk $417 to make $83. And someone looking at this would say, all right, I'm going to be successful on this. It's a 17 delta. And what I can do in Thinkorswim is, if I don't like to work with deltas, I can go and say, what's the probability of being out of the money? And the probability of being out of the money is 89.66%. Okay. So it's kind of the inverse of the delta. So I have almost a 90% chance of keeping this premium and a 10% chance that I'm going to owe, 407, it's going to cost me $417. Especially if it gets up to the $700 level. All right. But never let anybody tell you that, this one has a 80% probability of working or 90% probability of working. You can never lose. And a 75% or 80% or 90% chance is not 100%. And if you do this long enough, eventually you'll know. When you have the probability of being in the money or the delta, remember what I've said in previous, let me go back to delta here. It's an 11 delta. The probability that this strike will be touched is 2 times the delta, or 2 times the probability of being in the money. So when you think about probability of being in the money and probability of touching is 2 times. So there's a 22% chance we will come down to the strike. And now my earlier trade, which I said the 687, 692s, we collect $1.55. It's a 30 delta. You have a 60% chance of this, of the SPY coming and touching your strike. And this is when we start to get nervous, when the SPY keeps rallying and rallying, it's closer to our short strike. We start to sweat a little bit and we start to get worried. And as long as you remember that the probability of touching between now and expiration is 2 times your delta, or 2 times the probability of being in the money, because delta is the probability of being in the money. And remembering that it's 2 times that you might get challenged, then you'll know what is your comfort level with putting on a trade like this. Because if 60% of the market threatening your short strike gets you concerned, then move down to a 25 where it's only a 50-50 shot, or move down to a 20. In a strongly trending market with higher volatility, I'll make a 5 wide trade, 693, 698. That is $5 wide at the 20 delta. So if you have a strongly trending market or strongly trending instrument, then you might want to go to a 20 delta, which gives you an 80% shot of being right, but it's going to be very hard unless implied volatility is really jacked to get 1/3 of the width of the strikes. But 1/3 of the risk, 1/3 of the width of the strike is a best practice, but it's not a must. And I often do these kind of trades at a 20 delta, even though they're not going to give me the requisite 1/3 of the width of the strike, especially if I'd rather make and keep this money and not worry about getting run over by a market. Again, if I look over here, this is the expected move. That's the first stop that you want to make when you're looking at doing something like this, whether it's a put spread or a call spread you're selling. So there's a $26 expected move into expiration, which is 29 days away. So 26 plus 672 basically gets you close to 700. So 693 is right there on the dance floor in terms of being the edge of the expected move come October or November expiration. So that's on the premium selling side. The other side of this, and as usual, I've kind of overestimated what I could cover in one session, and I don't want to keep everybody too long since I started a little bit late. The other side of things is the in-out spread that I've talked about. All right. So the SPY is up $4.56. And I want to take a shot, whether it's 30 days out, or maybe I want to take a shot that's only give myself a week till Halloween. Halloween is on a Friday this year, so how fun is that? So this is something I often do. So, and people wonder, why bother? And you take what's called an in-out spread, and it could be $1 wide, $2 wide, depending on what instrument you're using. So you could buy a 673 call and sell, put. And remember, skew is in my favor because I'm going to buy the 14.47 and I'm going to sell the 671, and I'm going to sell a 14.96% implied volatility. You know, a whopping 0.5% difference in volatility, but believe me, it matters. So for a $2 wide spread. One's in the money and one's out of the money. That's why we call it an in and out spread with 8 days. And you can give it more time. You can go out another week if you don't think it's going to materialize. And notice that we pay even a little bit less because it's going to take longer for this to expand. So it depends on your time frame. But let's just stick with October 31st. So we have a week to be right. And I take shots like this all the time as well, especially when I think something has rallied too far. So I'm going to risk 75 cents. And what am I going to make? I'm going to make $1.25. So my max loss on this is $75, but I'm going to make $125. So 125, I think this is 60% if I'm not right, 67%. Okay. So this is another instance where you don't have to spend a ton of money and you are taking a shot with a potential of a 67% profit, and you are basically risking 40% of the width of the spread, or 75 cents, right? Or I guess you could say when you're doing this in-out spread, you're risking 33% to make 67%. And so the whole idea here is, we're risking one to make 66%. And some people might say, no, if I'm going to risk 75 cents, I want to double my money, or I want to triple my money, or what have you. But these shots matter. And if you do enough of them over time, and you are at the perfect time to put something like this on, and because the market is up, volatility is down, and the skew is in your favor. And so if you take a shot like this and you buy a couple of these, and if you're not sure if it's going to work out in a week, you buy one here, and then you come to the 7th and you buy another one here, and maybe you wait until the market rallies another $2. And so you spread your inventory over time so that you don't have to worry about concentrating. And so this kind of brings me to a little bit of conclusion on this, and we're going to continue, and we're going to go into skew and what have you. And I think for that, I'm going to have a PowerPoint presentation and kind of bring more of this home to you, so you understand skew, you understand more about volatility and its effect on here. But there's 3 components to making a decision on the trade. And remember, this is not just options. This is just trading in general. You can apply it to your general trading, and you can apply it to probabilities in the rest of your life if you really think about it. 3 components. We have trade logic, okay? The trade logic being, what am I going to risk for what kind of reward? And is it 1 to 3, 1 to 2, 2 to 1? And just remember, the higher the potential reward, the lower the potential probability. Obviously, that works very well, or that makes sense, right? Higher risk, higher reward. The other part is what a lot of traders struggle with, is how much of your capital are you going to allocate to? And so there's no shame in being capped in 1 or 2 lot or 3 lot, especially when you're learning this, because you're going to make mistakes. And if you're just beginning with option trading or trading in general, if you're going to make mistakes, you might as well make the small mistakes. Okay. And so you want to err on the side of under allocating. Most of the time when I see traders that are in trouble or blowing up accounts, they're buying 10, 20, 30, 40 lots at one time. And this is what blows up accounts side, guys. The third component is what most traders start with, is their bias. And for me, it's not about the bias. For me, I start about, bias being, are you bearish? Are you bullish? And while I think about that, and obviously I'm going to put a bullish trade on, I'm bullish. If I'm going to put a bearish trade on, I'm bearish. Captain Obvious here. So I start with trade logic. What do I want to risk for how much I want to make and what the probabilities are? And the second part is, you know, allocation. Spread your trades over multiple expirations and multiple strikes so that no one movement in the market can really wreak havoc on your account. Now, when the market's going in one direction endlessly, there's no avoiding it. Eventually, they come for everyone, whether it's on the downside or upside. And so we've been one way to the upside for a long time. And, Lord knows that I've had iron condors or short call spreads that have been run over and basically did the odds. So what I talked about today is basically understanding that it's not all about, making 2 to 1, 3 to 1. It's about the probabilities and managing your risk, managing the trades. And, when you have these kinds of trades and you think in these parameters and you give yourself enough time in your trades in terms of expiration, you have more time to manage them than, you buy a stock today, you expect to make $2 on it tomorrow, but what happens? It's down $2 at the open. No time to manage it. You're out based on your risk reward parameters. With options, obviously you have a lot of options and possibilities and more time to adjust things and manage things to perhaps get to a better conclusion. And that's why I do the trades that I put out for you guys are mostly out 1, 2, 3 weeks in time. And I don't do a lot of very short-term day trades or zero DTE trades because there's just not a lot of time to correct. And obviously I tried a couple of short-term lotto trades and neither one of them worked out. And that goes back to my history with day trading. I'm not very good at it. And so I wouldn't trust me either with these lotto trades, but I'm certainly trying to get better and giving everybody what they're asking for. So I'm going to wrap up this session here. And like I said, we'll continue with with this and get you into more depth next week. And so let me check. I think so I've got a long question here from Joe. I'm not going to try to answer this here. I'll answer him via email. I think this is more of a email response. This is long. So, and if I think it's relevant to the rest of the members, I'll post it in the forum. So sorry, guys, you couldn't do any questions in here and for the trouble. And I will be back with you. And let's see if I can get back on camera for the end of this. Over the weekend with my weekend video, and I will obviously be in the room with our trades today and tomorrow. So good luck to you. Don't fight this trend. It's only going up, up, up. And hopefully you're participating and making money on this. And speaking of which, been looking all day. None of our trades have moved enough for us to harvest or take anything off. So that's good that we're not being stopped out, but not so good that we're not able to take any profits. But this is a game of patience and that's hard to come by. I appreciate you guys attending today. If you have any feedback for me, sam@optionmarketmentor.com. Good or bad, love to hear it. And if you want me to make any changes, we'll get these kinks ironed out and I will see you next time. Take care.